a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about China Tech ETFs. And China Tech ETFs have been beaten down. It's been a tumultuous time for them, thanks mainly to regulatory crackdown in the country. But many investors continue to pour money into China Tech ETFs, which I find a bit intriguing. So that's why I decided to, discuss this topic today, because it seems that some investors believe that once this dust settles, China Tech ETFs are going to rebound, and this may be a good buying opportunity for those stocks and ETFs. And in fact, they are rebounding a little bit today, but it remains to be seen whether the worst is over. Cathie Wood, arguably the hottest fund manager on Wall Street currently, she warned of a valuation reset in China, and in fact, she sold most of the Chinese tech stocks from her ETFs. On the other hand, BlackRock says that China should not be considered an emerging market, and they recommended recently that investors should boost their exposure to China by as much as 3 times. And the most popular China Tech ETF, KWEB, this is down about 57% from its February peak, but it has gathered 3.8 billion in assets since then. So just to give a little bit of background, the problems with China tech stocks started, I think, in October last year. It all started when Jack Ma, the founder of Alibaba, the billionaire, one of the richest men in China, he gave a speech basically criticizing Chinese regulators for stifling financial innovation. And after that speech, the IPO of his Ant Group, which would have been one of the biggest IPOs ever, was cancelled, and Jack Ma has largely disappeared from public view. And since then, Beijing has stepped up the regulatory crackdown, and they have also widened the crackdown. It's not only internet companies, it's also healthcare, some of the healthcare companies, education companies, gaming companies, financial technology, fintech companies. They have imposed new rules regarding collection and use of personal data, and it seems that the Chinese Communist Party is kind of rewriting rules for businesses that have become too big for them to control. So there is definitely a lot of regulatory risk in China. So we will take a look at 4 ETFs today. 2 China Tech ETFs, KWEB and CQPQ, CQPQ has actually done better than KWEB this year as well as in the past, but it is not as popular as KWEB. And we will look at another emerging market ETF which excludes China and which has also seen a lot of interest from investors. And then we will take a look at the US tech ETF, which is one of my favorite ETFs. So the first one I'm highlighting is by CraneShares, which I mentioned has seen a lot of interest this year. KWEB, CraneShares CSI China Internet ETF. This holds Chinese internet companies, as the name suggests. It has 52 holdings, has an expense ratio of 76 basis points, 4.8 billion in assets, of which 3.8 billion has come since February. A lot of massive inflows into this particular ETF. Now, to learn more about this ETF, you can go to the quote page on Zacks.com, and from there, the external homepage. CraneShares has some good research on investing in China. So if you are interested, you should read some of their research. Now, looking at the top holdings, the well-known Chinese tech giants, Tencent, Alibaba, JD.com, Meituan, Pinduoduo, these are among the top holdings. Top heavy because these are the giants in the space. Now, the second one, which I briefly alluded to earlier, is by Invesco China Technology ETF, ticker symbol CQPQ. This has 107 holdings, so more diversified compared to KWEB, but is much smaller compared to KWEB, and this has seen inflows of 280 million since February. Now, again, to learn more about this ETF, you can go to the quote page, has an expense ratio of 70 basis points. And looking at the top holdings, you will see similar holdings, but somewhat smaller exposure to those companies, a little bit less top heavy and a little bit more diversified. So Tencent, Baidu, Meituan, these are among the top holdings in this ETF. Now, the third one which I am highlighting is by iShares. This excludes China, and as I mentioned, this has also seen a lot of interest from investors this year because some investors now totally want to exclude China from their EM exposure. So this is also market cap weighted, very diversified with 608 holdings currently. This has 1.2 billion in assets, of which 780 million has come since February, and very cheap with an expense ratio of 25 basis points. So again, to learn more, you can go to the Zacks quote page, and from there the external home page of this ETF, the iShares web page for the ETF, and you can see what it holds. So when it avoids China, the country that it has the most exposure to are Taiwan, South Korea, India, Brazil, and then Russia. And looking at the top holdings, the Taiwanese chip giant, Taiwan Semiconductor, that is the top holding in the ETF, almost 10% weight. And then Samsung Electronics, then the Indian energy giant Reliance, and Indian technology giant Infosys, Indian banking giants HDFC and ICICI. These are the top holdings in this ETF. Now, fourth one which I'm highlighting is for investors who believe that money which is coming out of China may continue to go into US tech giants. So if you want to invest in US technology companies, then you can look at the Invesco QQQ or its cheaper version, QQQM. So QQQ is suitable for traders. It has an expense ratio of 20 basis points and very liquid. QQQM with an expense ratio of 15 basis points is good for long-term investors. And this launched last year but has already gathered about 1.6 billion in assets. Now, I have discussed this ETF in the past too, but you can quickly look at the top holdings. So you get exposure to all technology giants, Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Nvidia in one ETF through this particular product. Now, on the next slide, I have the comparative performance versus QQQ. So these four ETFs, and you will see that QQQ is up about 20% this year, and the emerging market, excluding China, ETF is about 5%. CQPQ is down about 22-23%, whereas the KWEB ETF is down more than 50% this year. Now, on this slide, I have the longer term performance, about 4 years performance of these 4 ETFs, and I took this period because this is since inception of the emerging market excluding China ETF in July 2017. So you will see that QQQ is up more than 170% over this period. CQQQ and EMXC, they are up. They have similar performance between 25 to 30%, whereas the KWEB ETF is down. And you will see that both the Chinese ETFs have come down significantly over the past few months. But looking over the long term, you will see that CQQ was actually performing better than KWEB over the long term as well. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, our video channel, so that you do not miss anything. And I will see you next week.